Welcome back to Insights Now. I'm David Kelly, Chief Global Strategist here at JP Morgan Asset Management. We conclude our Moments in Market History series, joined by Grant Papa, a research analyst on our Market Insights team, to discuss the global financial crisis. Welcome, Grant.
Thanks for having me, David.
We're going to talk about the great financial crisis of 2008, 2009. Just in a nutshell, if you can put this in a nutshell, what happened?
Yeah, I mean, that's no easy task, obviously, for such a monumental and seismic market event that the Great Financial Crisis was. But in one sentence, really, it was a crisis started by the lax mortgage standards and the bursting of the housing bubble, exacerbated by complex financial derivatives and leverage that really brought the global economy to the edge of catastrophe. But obviously, that's a nutshell. That's one short sentence. I want to turn it back to you.
Yeah.
You lived and worked, during the 2007, 2008 time, and you saw firsthand, these events and what happened. Let's start with what caused the issue.
Yeah.
Dive into a little bit more detail on, the housing and leverage and derivatives. Let's first start with housing. Can you talk about, you know, why this happened, the use of subprime mortgages, what went into this inflation of the housing bubble?
I think the way to think about how this occurred or how it sort of basically rolled out is to think of it in terms of a fuse and a bomb. And the housing bubble was a fuse, but the complexity of mortgage derivatives, the interconnectedness of all these financial institutions, that was the bomb and the leverage. But looking at the housing bubble itself, it started, of course, as a housing boom. Um, Politicians of both parties in the 1990s and in the 2000s, they were agreed that home ownership was a good thing. We're going to increase home ownership. And Bill Clinton obviously wanted bigger home ownership, and George W. Bush also wanted big ownership. And so over time, this became a national priority. I remember there were a lot of bank mergers at the time, and one of the requirements was, not necessarily to have lots of competition, but are you going to make sure that you lend money to all sorts of borrowers? You're going to have a very expansive lending program for mortgages, and so that sort of got the housing industry going. And then people got more and more excited about housing. You had a growing population. You had laxer and laxer mortgage standards. We had more packaging of mortgages into collateralized mortgage obligations. That made it easier to service them and to sell them and to get them off your own books as a lender. But also you had people playing in the market in terms of, well, we're going to craft a mortgage which is easier for you. You're going to make an adjustable rate mortgage, so you don't have to pay such high rates. We're going to have loans which you don't have to put as much money down. Maybe you only have to put 10% down or 5% down or no percent down. So long as you had these private label mortgages, which didn't have to be conformable to Freddie Mac or Fannie Mae standards, you could do this. We had no doc loans where basically at for a little higher rate, you didn't have to prove in any great detail what your income was, which of course is a disastrous idea. And so you had all this credit flowing in. And because of that, people bought houses they really shouldn't have bought. And of course, it was the individual who defaulted on the loan or really shouldn't have been buying the house. But I do have a certain sympathy for people who weren't necessarily very experienced in financial matters. Honestly, they had a hard time keeping a job, or they didn't have much income. They had very little of a safety net, family safety net, personal safety net. But if a banker was going to lend the money to you, I think everybody's grown up in the idea that bankers are mean, tough people and they'll never lend you any money. So if a banker's saying, you want to take the money? Oh, no, why not take some more? Why don't you take out a home equity line while you're at it? And so if the bankers are willing to lend you this money, well, they must know what they're doing. It's their money. So people bought this. And so you saw a boom in housing. You saw a boom in people flipping houses. So people buy houses, do a little renovation and sell it on and make more money. Home prices were going up. People said home prices never go down. And actually, there's a very long series in which home prices never actually gone down year over year in America for many, many years. And so we got to a point where in 1985, there were 2.1 million housing starts. Population was growing, but wasn't growing that fast. And so, today we've got about 1.5 million housing starts, and even that's probably a little higher than the economy needs. But it got to this huge crescendo in terms of home building, and of course vacancies went up. people started defaulting on mortgages, and that really started the problem. You had a lot of people who just should not have been homeowners, who were homeowners in adjustable rate mortgages, which started going up. Of course, we saw increases in interest rates also, which didn't help. And all that came together and really triggered a lot of problems in financial institutions which had grown up around this housing boom.
Okay, so then you just laid out the housing part of it. So let's discuss now the derivatives and the leverage, which amplified
Yeah.
the issue. Can you talk a little about
Well, that's
that?
right. I mean, we had obviously the you could sort of look at the leverage in housing to start with in terms of these mortgages where you only put 10% down or 5% down. That's a very leveraged investment to start with. So how do you, if you're a private label mortgage originator, how do you deal with that? How do you lend money like this? Well, what they would do is they package them into a collateralized mortgage obligation, and then they would get the rating agency to say this is AAA, this is a AAA rated package of mortgages. And there was a very incestuous relationship between the originators and the rating agencies, because guess who paid the rating agencies? The originators. And so the originators were saying, well, if we got these mortgages from Washington State, we've got some subprime stuff from Detroit. How many good mortgages do we have to put into this thing to get a AAA rating? And so they would actually package things right at the edge of what the mortgage companies would go, or what the ratings agencies would give them for a rating, and then they sold them all around the world. And you would there were immense sophistication in all these mortgages. You could have you might be entitled to the interest, and somebody else is entitled to the repayment of principal. Somebody would take the first set of losses, somebody else would take the next set of losses. So there's immense complexity. And when you've got complex financial instruments, everybody pretends they know what it means, but they don't really. But they were sold around the world. It wasn't just, this is why the great financial crisis, we're just arguing actually, should be called a great financial crisis, a global financial crisis. If it had just been the United States, it would have been the great financial crisis. But thanks to the fact that we managed to sell these mortgages all over the world, and it actually affected the banking system all over the world and the economies all over the world, it really was kind of a global financial crisis.
Yeah, and then in my research and in this topic too, you saw even some of these CEOs of these companies didn't even understand how complex these derivatives were that people within
Well,
the company were using.
yeah, and I think the mortgages, the collateralized mortgage obligations were one level of complexity, but then we had huge growth in the derivative markets quite apart from that. So you had first of all you had believe it or not, no matter given the amount of mortgages that were being issued, you think there were enough mortgages. There weren't, not for all the people who want to speculate. So there were companies who made synthetic mortgages. And so okay, I'm going to put together a derivative which is going to track this particular collateralized mortgage obligation. And then in one particularly notorious example, a certain company decided to produce inverse collateralized mortgage obligations to help out a client of theirs. So basically, okay, I want you to put together this synthetic mortgage and sell it to people so I can short it. And so they did that. And so you had all of that. But on top of that, there was a layer of credit default swaps. So this was a way of trying to buy insurance at some level against what happens if all these mortgages go bad. But then, of course, you got counterparties also who would be called to cough up if these bonds defaulted. And so we built this enormous edifice of risk and derivatives on top of the housing market. And I think that was one of the things that really confused everybody at the time, because home building in the United States, it's about 4% of GDP. At its peak, 1985, 1986, it was about 6% of GDP. That shouldn't be enough to take down the whole economy, but it was, because of the way that the risks on Wall Street had been amplified by derivatives based off the housing bubble.
Okay, so let's walk through now at how it all unfolded, because there's so many factors at play. It's almost like a drama made for a movie
Yes.
or a TV series. I'm sure there actually has been made now.
Yep.
Um, you know, just to name a few, you have Bear Stearns, starting to fail and getting acquired by J.P. Morgan. You have Lehman Brothers failing. You have AIG wobbling. Fannie and Freddie
Yeah.
started to wobble. So can you just walk through?
Yeah, it was. I must say, for regulators, it must have seemed like whack-a-mole. So the first inklings of a problem really occurred in '87. Oh, sorry, in 2007, where there were certain funds run by Bear Stearns which got into serious trouble because there were just mortgages in there that shouldn't have been in there, and the Federal Reserve had pushed up more interest rates in 1986, in 2006, to try to slow the housing bubble a bit. But of course, that meant that these adjustable rate mortgages were now in more trouble. So you had some problems there, and of course, all the investment banks were using tremendous leverage themselves because they were trying to make money on their own account, which meant that a small loss of these mortgage portfolios could put them in serious financial trouble. So Bear Stearns was the first obvious one when it was in trouble in March of 2008. Um, but then you also saw we had problems with Freddie and Fannie, which were they were supposed to just be doing conformable mortgages. They actually bought some private label mortgages also, and they found themselves undercapitalized. And so Hank Paulson, as the Treasury Secretary, was busy trying to figure out a bailout package for Fannie and Freddie. Had to bail out or had to arrange a private takeover of Bear Stearns by J.P. Morgan, and then we had the sort of few days, weeks, and days that led up to the bankruptcy of Lehman Brothers, which really was the crescendo of the crisis, where um, they tried various mechanisms to try to find to orchestrate a private sector bailout of Lehman Brothers. And I remember vividly that weekend, the assumption was that Bank of America was the obvious candidate to buy Lehman Brothers because we had J.P. Morgan just bought Bear Stearns, and it had helped with other banks, and at that point, J.P. Morgan just did not want to absorb another bank. But Bank of America ought to be able to do that. But over that weekend, Merrill Lynch realized that they could be in problems too, and so Bank of America and Merrill Lynch took over Merrill Lynch, and that meant there was no suitor to buy Lehman Brothers. Now, there was a lot of negotiations going on with Barclays, which ultimately regulators in Britain nixed. Barclays did end up owning part of Lehman Brothers, but only after it had gone bankrupt. And ultimately, I do think that a decision was made at some stage that we were going to let Lehman Brothers fail. The U.S. government was going to let Lehman Brothers fail to avoid moral hazard, to avoid giving the impression that you will always get bailed out, whatever the risks you take. And I think some of that harkens back actually to a decade earlier with the collapse of long-term capital management, where the government did, the New York Fed orchestrated a private sector bailout, but a lot of people said, yeah, that's not great. You're bailing out these guys. Now, to be honest, the principles in long-term capital management weren't bailed out, and the principles in Bear Stearns and Lehman Brothers really weren't bailed out either. But that's not the point. The point is politically, we're in the middle of election campaign in 2008. The Bush administration decided they weren't going to do whatever was necessary, whatever it takes to rescue Lehman Brothers. Lehman Brothers went under, and then everything just froze because the problem was, again, derivatives. The problem with derivatives is not whether if you could slowly, methodically go through the derivatives and unwind it, would there be a problem? The problem is nobody knew who owed what to whom. And so if Lehman Brothers goes under, what's the exposure of this bank or that bank or that bank? And so credit just froze up. And then finally, and this is one last part of what was going on right at that time, we had a huge problem with AIG because AIG is an enormous insurance company, had massive assets. The problem was it also had massive um, uh, exposure in the derivative markets, particularly to CDSs. And the assets that it was using sort of on the other side of this weren't liquid enough to actually meet these CDS liabilities. So the government then had to step in and rescue AIG a week after letting Lehman Brothers fall. So it is pretty dramatic. And all the time, the market is just bleeding red ink. It was pretty dramatic times.
It's almost like an iceberg where you see what's above the water, but below the water is really where all the derivatives and leverage and what's amplified.
Yeah, and I think Andrew Ross Sorkin's book, although I know it is a big tome, but it's good. But it just you sort of feel the level of exhaustion of all these executives as they're going from one crisis meeting to another, as they were trying to sort of shore up the dam of the mess that this construct of a housing bubble and edifice of derivatives really caused. If you're here for the why behind market turning points, Alternative Realities brings that same approach to alternatives, spotlighting the shifts reshaping the alternatives landscape. Hear from industry experts and distinguished guests on the strategies and trends shaping the future of alternatives. Listen to Alternative Realities today, available wherever you get your podcasts.
So then you mentioned it kind of in the tail part of your answer. The government steps in.
Yeah.
So can you talk about, and by the way, there's a lot of names now that are still back in. Kevin Warsh is was around during that time. He's now obviously the new Fed chair. Can you talk about what the government did to help stabilize markets and what was this troubled assets relief
Well,
program?
yeah, so it was a particularly tricky time, to be fair, for the Bush administration because they were in the middle of an election campaign, but they had to do something. And so what they came up with was a troubled asset relief program. And the idea actually was quite good. It was that we're going to try to put together, borrow a whole pile of government money, try to buy up the toxic assets, and they're really, I think everybody realized at the time the assets aren't necessarily that toxic, or they, if everything can just clear, there's probably a lot of value there. Not everybody's not going to lose their money, but they needed to come up with a massive amount of money to do this. And so they came up with I think the original bill was like 3 sheets of paper, and it said basically the Congress is going to authorize a $700 billion relief fund to buy up these toxic assets. The problem was in the political environment, the Bush administration couldn't get Republicans on board. The Democrats couldn't get all the Democrats on board, and so Congress voted the thing down. And so then you had this cataclysmic drop in the stock market, just getting worse and worse. And then finally, that was at the start of the week. And by the end of the week, the sort of ashen-faced congressmen and women decided, well, maybe after saying, well, fix this and fix that. And usually, I mean, the objection to it was, you're rewarding bad behavior. You're rewarding all these fat cats on Wall Street. What about these guys who've lost their mortgages of their house? It was a fair criticism, and you needed to do something, or you ought to have done something about that too. But it was just politically very unpopular, but it was absolutely necessary to actually bail out the system to prevent a collapse which would have been as bad as the financial collapse that started the Great Depression.
I'd like to dive into that a little bit more. And so, like, okay, the bill passes.
Yeah.
What's the aftermath of this? And how do you balance that viewpoint of, supporters of the TARP, bill that, okay, this helps stabilize markets. It could have got a lot worse versus, naysayers or people who oppose the bill saying this really rewarded a lot of bad behavior.
Yep.
And it's, the fat cats kind of getting away with wrecking, almost bringing the financial system
Yep.
to a collapse.
Well, I think the first of all, let's talk about how they really finally got to stability, because I think there's a very important lesson in that, and then I want to talk about the whole issue of moral hazard. So the original program, the original idea is you're going to buy up all these toxic assets. The problem was it's just too complicated. And so they realized they'd never be able to deploy this. They were either overpaying for them or underpaying for them. So then they came up with the notion, well, we're not going to do that at all. What we're going to do is we're going to go to summon the leaders, I think it was of the top 10 financial organizations in the United States, to the White House. And we're going to put them around a conference table and we're going to say, you are going to take this money. We are going to give you, JP Morgan, $25 billion. And even if the head of JP Morgan said, we don't need $25 billion. No, you're going to take it because you don't take it, nobody else is going to take it. It's kind of like borrowing at the discount window. It seemed as disreputable, can hurt your reputation. So basically, the government forced these big institutions to take the money. And when they took the money, then people realized they better capitalize. So that helped. But even then, the market didn't really stabilize. Who really stabilized the market was in March of 2009, in one of the iterations of trying to bail out the system. The government and the Treasury Department said they named 30 companies, 30 big financial institutions. They said, these companies we will not let fail. We will put in whatever capital is necessary. We'll replace the boards, we'll do whatever, but they are not going under. If you got money in these institutions, you are fine. In other words, what they did say was these companies are, in fact, de facto too big to fail, and we will not let them fail. As soon as everybody realized they are, in fact, too big to fail and will not be allowed to fail, everybody, sigh of relief, everyone, and then the expansion could start. And of course, we had various stimulus packages under the Obama administration to get the economy going. It didn't get going very fast because you still had a very restrictive credit. Nobody wanted to make bad loans again, bad mortgage loans or other loans. And so the economy grew very slowly, as it often does after you come out of a credit crisis. But that was the single act. The irony of it wasn't saying the companies could never be too big to fail. It was saying the companies precisely were too big to fail. And that gets to the moral hazard issue. The time to get all moral about these things is not in the middle of the bust, it is in the middle of the boom. And we miss this point over and over and over again. By the time they let Lehman Brothers fail, the sand was disappearing beneath their feet. Do not draw a line in the sand when the sand is disappearing beneath their feet. It just made the problem worse. They should have years earlier said, well, you know what? I don't care whether these mortgages are backed by Fannie and Freddie or private sector mortgage. They shall not be enforceable in a U.S. court unless you have done certain things in terms of due diligence in granting this mortgage. So you've got to verify the income. You've got to have a certain amount of money down. You've got to have a certain credit score. They should have done that. They should have stopped the predatory lending in the first place. But of course, nobody wanted to do that at the time. And even today, there are, the issue is not, should we bail out companies in a crisis or bail out the economy in a crisis? Of course we have to. The real issue is, should we do things from a regulatory perspective to prevent these excesses occurring? And when I look at, for example, the lack of regulation, things like cryptocurrency today, I want to pull my hair out. I mean, these are, there is, I mean, I have a strong view on this. I don't think that cryptocurrency should be allowed to exist at all, period, full stop, and end of sentence. But they certainly should be more carefully regulated. And that's true for a lot of investments today. But the hand of regulation is very light in the good times and is very heavy in the bad times. And that actually makes the economy and financial markets more cyclical, not less.
So then when thinking about investing for, and financial markets overall, what did we learn coming out of this crisis? And then I'd like to, bring it to some of the headlines we're seeing today in private credit. How do you think about the events of 2008, 2009, and then some of the headlines and some of the concerns there are today about what's going on in that area of the market?
Yeah, I mean, I think one of the lessons are that leverage and complex financial instruments are dangerous, and they can make a markets behave in a very non-normal fashion and see these huge, elevator drop plunges in prices. And so we had over leveraged investment banks back at the time who required a lot of short-term funding, and of course we had all this complexity in derivatives. So I think for individual investors, you can't expect that these things are not going to be there, but don't get too pulled into it yourself. Buy things based on valuations. It's perfectly reasonable to be optimistic and have some money, put a few chips on things that are fast growing that you think deserve higher valuations, but you've got to be rational about what you're buying, and you've got to spread it out because you don't know where the next crisis is coming from. So I think for investors, that's part of the story. Could it happen again? There are certain things that make us less vulnerable. I think we saw a mini banking crisis back in 2022, which was squashed out immediately because the government was very aggressive in saying, even though these deposits aren't insured, we're going to make sure nobody loses their money. We're going to step in and take these banks over, get them out of, get them into safe hands. So I think both the Federal Reserve and the federal government have always been more aggressive. I think they learned the lesson of Lehman Brothers. Private credit, I think you're more of an expert in private credit than I am, but I think as we've talked about it over the months, there's been a lot of money has gone into the area. There may well be, and there will be some private credit loans which just should not have been made and will default. But I think from a systematic perspective, there isn't an edifice of derivatives built on these private loans. So I think that lack of connectiveness with the overall global financial system is very important. I think that means that private credit could be a private disaster for people rather than a public one, such as was the case with the great financial crisis of 2008, 2009.
Well, thank you, David.
Thank you, Grant. And thank you all for joining us in our final episode of our Moments in Market History series. We hope you enjoyed the show. Be sure to come back for more episodes of Insights Now and Alternative Realities.
This material is for information purposes only. The views, opinions, and statements of financial market trends that are based on current market conditions are those of the speaker and may differ from those expressed J.P. Morgan Asset Management or by other areas of J.P. Morgan Chase & Co. Any companies referenced are shown for illustrative purposes only and are not intended as a recommendation. We believe the information provided here is reliable, but should not be assumed to be accurate or complete. The views and strategies described may not be suitable for all investors. This content is intended for information only based on assumptions in current market conditions and are subject to change. No warranty of accuracy is given. This content does not contain sufficient information to support investment decisions. It is not to be construed as research, legal, regulatory, tax, accounting, or investment advice. Investments involve risks. Investors should seek professional advice or make an independent evaluation before investing. The value of investments and the income from them may fluctuate, including loss of capital. Past performance and yield are not indicative of current or future results. Forecasts and estimates may or may not come to pass. JP Morgan Asset Management is the asset management business of JP Morgan Chase & Company and its affiliates worldwide.